listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hello, this is Jordan, and this is a solo commentary for today. There are many things we can do to avoid mistakes and reduce risk. Properly managing your portfolio is one. Things like trimming big winners and cutting losers is essential. Remember, a 20% loss on a 5% position is 1% of your portfolio. That's one way to assess risk. To take it one step further, assessing company weakness is a vital but difficult task. I'm speaking about significant weakness in a stock, not just a 15 or 20% decline. When evaluating these situations, the question you have to ask is a major decline in this stock a buying opportunity, or is it due to something that can't be remedied or rectified, some kind of problem or a fatal flaw? This is something I wanted to discuss in the wake of the debacle in Pure Gold. Now, in my own experience, significant weakness in a stock, be it nominal or relative, in a developer building a mine or an existing producer building another mine, a significant weakness in these types of situations, it's a red flag. And the red flag can manifest itself in one of, several different ways. The stock can be really badly underperforming, or the chart can look really ugly several months, 3, 4, 5 months before the company's going to go into production. You could have a CapEx blowout. Suddenly they need more money. They need a lot more money. It's way more expensive to finish building the mine. They started producing, but the grade is coming in way too short, much lower than what they expected. The lender suddenly is going to pull their loan. The company suddenly has to raise a little bit more money than they expected. And, some developments are more significant than others. And sometimes a series of small negatives along the way can pile up, and the stock can slowly grind lower, giving you a chance to sell before potentially really bad news if that comes into play. Now, in some cases, these problems are never rectified because they can't be. In my experience, it's usually not a good idea to buy weakness in these companies when the cause of the weakness is in the company's control. Now, a developer stock declining 40% because the gold price is down 15 or 20%, that's an entirely different scenario. We aren't talking about that. Now, if it is a turnaround play, the time to buy weakness in that situation is after the company has already had 1 or 2 good quarters and the stock has bottomed. Yes, there's less upside in that situation, but you have a much higher probability of success because the evidence shows the problems are behind that company. They're in the past. Now, otherwise, you're just hoping for good news in a turnaround, and that's not a wise strategy. Now, moving on, with respect to exploration companies, buying weakness can work more often because the nature of the business is really cyclical. These companies can sell off 40%, 50%, 60%, and after that, the value can potentially really improve. You have to identify why the stock declined that much in the first place. And you have to rule out fatal flaws in projects. Things like the grade is too low, the metallurgy isn't going to work, the project will never be permitted, the company's going to have trouble raising the capital to eventually build the mine, et cetera, et cetera. Once you can rule out those fatal flaws, then you have a chance to find real value in exploration companies that have sold off significantly. In conclusion, when we're assuming a flat metals market, so putting that aside, I usually prefer buying weakness in explorers and avoiding weakness or selling weakness in developers and producers. Negative developments before or during the building of a mine can be a harbinger of more weakness down the road. That's not always going to be the case, but in my experience, the probability is that it more often than not is the case. And that's why when investing in or thinking about investing in developers and producers, and when these problems are showing up and the stock is starting to perform poorly, that's why you really have to be careful and think about cutting your losses and investing your money elsewhere in something that has a higher probability of success and a better risk-reward potential for you.
Thank you for tuning into the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.